We've got some formulas which are in the assigned reading, and I want to reiterate the fact that we are not required to actually use them for any calculations. It's about understanding rather than doing, but of course best way to understand is to do some examples, which we will. But we have to come back to the idea of how you would compute, in this case, the price of a forward contract. And we're basing it on the principle of arbitrage yet again. So arbitrage and replication. If you were, for example, having a forward contract on a bond, for example, you would say that you could replicate what the forward contract is giving you by just buying the bond. There'll be the spot price to pay. And of course, let's just remember that we're pricing the forward based upon risk-free rates, risk neutrality is assumed. But you would have to fund that transaction at the risk-free rate. So we'd have to consider the spot price, borrowing to buy the asset, fund at the risk-free rate. So that's going to be a cost to you. How much is that going to be? So sort of a finance cost. But also, buying the bond and holding it to a date when you actually need it may well mean that you collect some coupons, which was just a nice thing that you get from being a bondholder, some income payments. And that will, of course, reduce the cost to you, if you like, overall of holding the bond to when you need it. So what we could do is consider that the forward price should reflect the cost of buying the bond, funded at the risk-free rate, and netting it with the, I suppose, the present value of any expected income over the period, also discounted at the risk-free rate. Now, if we can agree, folks, that that would basically replicate having a forward, then the two give you the same end result. They should be priced in the same way or cost the same. And so we see that the forward price, now it's written, guys, the forward price today, set today, so time, the forward price agreed at time naught, so F naught, for a forward contract expiring at time T. So essentially agreed now at time T, of course, the actual expiry date. Okay, so agreed now, expiring at time T. We said would be, and this is really fundamental here, spot price will be compounded at the risk-free rate. Hopefully we can agree that that is true because, well, the combination, remember we had said earlier, the combination of that forward contract, agreed today at, and of course expiring at time T, as a return, combined with the spot price, so spot price today, S naught, should be equal to the risk-free return over the time T, because you are exposed to no risk by combining the two together. A riskless combination of the derivative and the underlying asset should earn you the risk-free rate. That's of course fundamental in our sort of statement earlier. Therefore, we can say that the forward price agreed today for expiry at time T will be equal to the spot price compounded at the risk-free rate over time T. Right? The spot price compounded over time T is what that is, of course. Okay, but remembering that if there are any benefits to you of holding the underlying until the assumed expiry date of the forward, well, that would reduce the cost of holding the asset. It's sort of a benefit of carry, if you like, as they would call it. A benefit of carry, which would reduce the cost of holding the underlying and will be reflected in the forward contract. And so we would basically net that off. As we say, net off with any sort of future value. Of course, this would be expected benefits, but benefits such as coupons on the bond during the period of holding. Okay, so that's basically what the formula shows us. And you can, of course, write that in that way if you prefer. What you could, of course, do is just net the spot price and the current value of benefits and combine the whole thing at the risk-free rate, because we are going to be using the risk-free rate basically for everything. Risk neutrality is assumed for future values of the spot price and indeed of benefits. So whether you use, folks, the formula, I mean, we basically have talked about this lower formula here. You could, of course, just combine the two together and say take the present value of the future of the benefits over the holding period. So rather than compounding it, you first discount the expected coupons on the bond and net that in one go with the current spot price of the asset, and then compound the whole thing to the maturity date at the risk-free rate. But you, of course, come with the same answer either way. So just to see this, folks, the terminology here, of course, S0 is the spot price of the underlying at the contract initiation. PV and FV of CF is just the present and future value of cash flows on the underlying during the life of the contract. And yeah, I mean, in between initiation and expiry, either we could PV the cash flows and then compound the whole thing to expiry, or we could just compound it to expiry date and net it with the spot price compounded. R is the risk-free rate on borrowing and lending, and say expressed on an EAR. Guys, EAR, remember from your quants reading, stands for the effective annual rate. So in other words, the key thing, of course, folks, is the word effective. It means that the rate is a compounded annual rate. So that's the most important thing. Compounded annual rate. If you have to de-annualize your rate, you'd have to use the relevant fractional power to de-annualize it. It's not a nominal rate where you could just, for example, a semi-annual, just halve the rate. You do not do that. It's an effective rate, so you have to raise to the power of a half, for example, rather than multiplying by a half. And T is the time from contract initiation to expiration, so the initial term of the contract. That, of course, will reduce to zero. But we do have to consider what the value of a contract may be during the life of the contract as well, and so we'll have to state that in a moment. However, guys, I hope this is okay in terms of what we were saying and what we were agreeing. Well, I think we should do some numbers, don't you? You try some numbers, it just makes it easier. So, arbitrage and forward pricing, let's have a look at this. The value of a forward at initiation is supposed to be 0 due to being arbitrage free. Okay, so let's imagine we take that as given, and we say we want to work out the value of a forward price. Fairly, yeah? Arbitrage free price means it's fair. Because if it wasn't, arbitrage would force it to be fair. So we end up with the same number, right? Stock is priced at $100. Okay. I suppose we say that's the current value, S0. 1 year interest rates are 5%. I'm going to assume that is the risk-free rate. The risk-free rate on an EAR basis. The stock will pay a dividend of 30 cents in 6 months' time. So, okay, so if you were to buy the share, you would be able to get the benefits. In 6 months' time. Okay, so it's not at the end of the contract's life, or not at the beginning of the contract's life, let's imagine, because we are going to be talking now about what is the arbitrage-free price of a 1 year forward, take into account everything we've said already. Okay, so what do we think? Talk about fair value, but the price, based upon the spot price, $100, compounded at the risk-free rate, yes, for 1 year. Right? However, reflecting the benefits of holding the actual share, you'd actually get a dividend payment of 30 cents. Now, we can do in one of two ways here, but since I've already compounded the spot price, I think I'll also just compound the actual dividend as well. So let's do that. Let's compound the dividend of 30 cents. How long should we be compounding for? Well, the future value at the end of the year would be the 30 cents compounded by 6 months. So I'm going to use the power. We can, of course, do 6 months over 12. We can simplify that to a half as well. Okay, so I could maybe just write it as a half easier. Half the year to compound forward and net the two off. So let's just try, folks, that. Fair value, 100, of course, first times 5%. Now that gives me 105. Let me just write these numbers down. I've got 105 there. Netting it off with 30 cents times 5%, power of a half. And this I'm getting 0.30741. So I'll just write all my numbers out there. Of course, that's cents as well. About 30 cents, but just over 30, just about 31 cents. And net the two off. And I'm getting $104 and 69. 104.69 is the arbitrage pre-price of the 1 year forward. And initiation of this contract, we say that would give it a zero value. Okay, and is also referred to, essentially, if the value is zero, as it would be here, it would be called an on-market forward. So anytime you have the initial contract with a value initially of zero, we refer to it as having being an on-market forward. It's neither an asset nor a liability to either side, and that would be certainly the case here. Both buy and seller. It's neither an asset or a liability. Now, you can imagine if the forward price was not 104.69 for this example. Let's imagine the price was set at 105. Let's imagine the buy and seller. So let's just round the number. Why have it as this number? Let's say 105 is just a rounded number. Let's do that. But if we leave it like that, then the buyer essentially is paying more than they should be to basically buy forward. They should be paying more than they should be. So the difference between $105 and 104.69, let's say the 31 cents basically, is something which the seller would have to pay the buyer as an initial cash flow to compensate them for what would be called an off-market forward. So an off-market forward would be any time the initial value of the forward is not zero. It could be higher than it should be. Well, that's the case. The short compensates the long for basically buying at a high price. And if the value of the price of the contract is below, let's say it's at 104, you just round it down, well, then it's the long who has to compensate the short, because the long is basically being able to buy at a price which is lower than they should be able to. It's an off-market forward because the initial contract value is not zero. It would actually be a positive value of about 69 cents to the buyer, but they would compensate the seller by paying 69 cents initially, and that would make everybody happy. That would basically make it as good as being an original on-market forward. So be ready, guys, to answer questions about what is meant by the term on-market forward. It just means that the initial forward price, derivative price, is with a contract value of zero, and therefore there is no need for any cash outflow from either side to compensate the other. But if the forward price is off-market, is off-market forward, then the initial contract value is not zero. It's either negative or positive at either side. And whoever it's positive to must compensate the other by that amount to make sure that it's fair. Now, we also have the formula here for the value of a forward at any time. So after initiation, okay, after initiation, which is really key, we say the forward contract valuation is basically seen to here from the perspective of the buyer. Okay, buyer's perspective. We would say, let's have a look at the spot price currently. So we say ST, so this is at the given time during the contract's life. Let's consider that and net that off against the present value of the forward price which you had locked in at the beginning, time 0, to receive at time t. And of course, by netting that off, you'd see that if you're able to lock in a forward price below the current spot price, in terms of present terms anyway, that would be a benefit to you as a buyer. We can see that it would be. However, of course, the other thing is that this benefit is reduced further by the fact that you are not able to get any cash flows, because by, of course, buying the forward contract, you haven't bought the asset. You've not been able to get any income, for example, on a share or coupon on a bond. And we could discount that as well to say, well, what is the effect of you losing that? And that would reduce your overall benefit of the forward. However, from the buyer's perspective, the value of the forward would be the price of the underlying at time t netted with present value of remaining cash flows at that time and the present value of the forward price. So we know at initiation, the value would be assumed to be 0, assuming an on-market forward, as we were just saying. But during the contract's life, the value can be positive or negative, and we say V subscript T there to say the value at time t can be positive or negative, since the forward price, although that's fixed, guys, of course, the spot price is not. And that changes, that's going to alter whether it's a benefit or loss to you to have locked in the forward price. The forward price is fixed, unlike this not. At expiration, though, the value of the forward, so the value of the forward at time t is just to the buyer the netting of the spot price and the forward price. No discounting required, of course, because we have now hit the date at which it is really a spot price anyway. The valuation, guys, to the long is this way, the buyer. For the short, we can imagine, it's just a sign change. Because there's no need to say, well, what does the short formula? You just, if it's positive to one, it's the same number, but negative to the other, and vice versa. Let's consider folks, for this example, right, just going back to example 17.1 there, stock price $100, 1 year rates 5%, stock will pay dividend 30 cents, 6 months time. We said the fair price 104.69. Let's imagine two months after contract initiation, stock is now priced at $102. Okay? Now, let's keep everything else as they are. The risk-free rate we said was 5%. It still is. The risk rate is still 5% per annum. But the question is, what is the current value of the forward? Now, I just want to use the same example that we've just started. Let's just continue it on. And we've already, of course, worked out the forward price at initiation anyway. So, from the perspective of the buyer, we can do the value as being, take the spot price of the asset. Now, I can see that's 102. Start with that. And, okay, following the formula, it says netted off against the remaining cash flows, and that's just to be discounted, and also the present value of the forward price. Now, if we do netting it off against the remaining cash flows, well, there's only one payment. We said there was a payment of, was it 30 cents? There's that term there. Yeah, so the example we said was 30 cents in 6 months' time. Now, in 6 months' time was at the initiation of the contract. You're now 2 months in. So how much time is there still to wait for that payment, of course, guys, to discount it? There's, 6 months has now reduced to 4 months. Can we see that? 6 months now reduced to 4 months. So we're going to say, let's discount. Okay, discount our 30 cents by basically 4 months over 12, or of course we could write that as a third if you prefer, just simplify that. And we are also going to net that off with the present value of the forward price, which we said was roughly 104.69, also discounted at 5%. That, of course, folks, is now a 10-month forward, isn't it? Because we had 12 months initially. There are 2 months already into the contract, so 12 minus the 2, that now gives us 10 months to go until the expiry date. That's 10 over 12. Of course, you do 5 over 6 if we prefer to simplify that. But that's it. That's going to give us the valuation. Now, if you try those numbers, folks, let's see. Getting my answer, folks, here, 1.186. Or we can round, of course, here, if you just prefer to 1.19. But either way, something in the range of about $1.19. Let's see, we just round that answer to 2 decimal places. Okay, now the value is positive. You can see that it is. And to the value of the buyer, it's positive by $1.19. Of course, the seller, it would be a negative value of $1.19. We have basically made sure that we've equated, or netted off, I should say, the current spot price with the present value of expected benefits over the holding period and the present value of the forward price, which has been locked in at the initiation. We have discounted everything at the risk-free rate, and assuming that it is a effective annual rate, we have discounted by, of course, the number of months that should be respective to the period. So for the current dividend payment, which was 4 months away, we discounted by 4 months over 12, and for the forward price, which was 10 months away, we discounted by 10 months over 12, and that gave us this value of $1.19.